tax on trades of stocks, derivatives, and other financial instruments. It's hosted by the Center for Study of Responsive Law, and it's close to 2 hours.
But right now, it's okay? All right. Welcome. My name is Ralph Nader. Today, the Center for the Study of Responsive Law in a series of debates on generally taboo subjects in both political, legislative, and mass media arenas. The topic today is variously called the Wall Street trading tax, the securities transactions excise tax, or the financial transaction tax. Taboos exist in all cultures, and our society is rife with them. It is remarkable that with all the current preoccupation of the major political parties and their governmental representatives with deficits and debts, spending and revenue, a major form of public revenue from financial transactions is hardly on the screen of their consideration. It was not always so. Until 1966, our country did have a transfer tax of 0.2% on all sales or transfers of stock. It reached that level in 1932 under Franklin Delano Roosevelt to boost financial recovery and job creation during the Great Depression. After 1966, discussion of the tax went cold. Though as trading volumes skyrocketed, here and abroad, there was considerable discussion in foreign countries and some adoption of financial transaction taxes there. My experience in speaking around the country about what is essentially a sales tax on the buying and selling of financial instruments is that people, once it's brought to their attention, sometimes make a comparison with the sales taxes they pay when they buy furniture, clothing, hardware, services, and sometimes even food. Why, they ask, do they have to pay a 6 or 7 or 8% sales tax on the necessities of life, yet Wall Street traders, no matter how much they buy, pay 0 sales tax? To be sure, there are bills filed on imposing this tax on financial transactions by a handful of members of Congress now, but they've been ignored by both the leadership and the committee chairs and the president, and thus can be considered dormant, ignored by the mass media as well. Last month, the fast-growing California Nurses Association and its affiliates in other states have adopted the, quote, Wall Street tax for Main Street, end quote, as a major initiative that started with a rally opposite the New York Stock Exchange. The Wall Street traders looked out on the ralliers with curiosity, but it appears they were not amused at all. Discussion of a financial transaction tax can radiate in many directions. It can be elaborated with endless variations and steeped in infinite dimensions. Today's debaters and moderators are so knowledgeable about this subject that they will be able to identify and clarify the points they wish to make or prod others to do so in understandable language. Nonetheless, the subject is not simple, especially when it is contested. The audience and the national audience reached by the presence of C-SPAN and other media here may need their better concentration on the details as they think about the more general principles of fairness and equity in our tax laws. Once the debaters make their presentations and responses, the moderators will expand the discussion. Then the debaters will be given an opportunity to question each other, followed by written questions from the audience, which include over 30 students visiting from other countries. And if you're going to write your question down on a card, please write very, very legibly and even try to print if you can. The debate will close with final comments by the debaters. Now to introduce the participants and the moderators. For the affirmative in favor of a securities transaction tax is Professor Robert Poland from the Department of Economics at the University of Massachusetts in Amherst. Mr. Poland's research centers on macroeconomics, conditions for low-wage workers in the U.S. and all over the world. The analysis of financial markets and the economics of building a clean energy economy in the U.S. His books include Measure of Fairness, The Economics of Living Wage and Minimum Wages in the United States, and an employment-targeted economic program for Kenya, and a similar one for South Africa. He's written the book Contours of Dissent, U.S. Economic Fractures in the Language of Global Austerity, and the book of which he is an acknowledged expert on the living wage, building a fair economy. More recently, he co-authored the widely debated study, Green Recovery, the Economic Benefits of Investing in Clean Energy, and also another monograph called Green Prosperity, exploring the broader economic benefits of large-scale investments in building a clean energy in the economy in the United States. He's currently consulting with the U.S. Department of Energy and the International Labor Organization. He has in the past worked with the Joint Economic Committee of the U.S. Congress and as a member of the Capital Formation Subcouncil of the U.S. Competitiveness Policy Council. In the negative, opposed to a financial transaction tax is Professor James Angel at Georgetown University. Coming from the California Institute of Technology, where he earned his BS degree, he got a PhD at the University of Berkeley in finance, and an MBA from Harvard Business School. I might add that Professor Pollan got his PhD from the New School for Social Research in New York City. Professor Angel began his professional career as a rate engineer for Pacific Gas and Electric, where he worked on regulatory issues. He is an author of many books and is often quoted in the major press on financial issues. He is he served as a visiting academic fellow in residence at the National Association of Securities Dealers. He has visited over 50 stock exchanges all over the world, even was an advisor to the Shanghai Stock Exchange. And he now is on the NASDAQ Economic Advisory Board and a member of the OTC Bulletin Board Advisory Committee. He currently serves on the boards of directors of the Direct Edge Stock Exchange. We have two moderators who also have a particular point of view, and I thought it would be good to have a knowledgeable moderator, even though one is against and one is for, rather than have a not knowledgeable moderator and allow the debate to sag a bit. Opposed to the transaction tax, but moderating half of the time here, is Gus Sauter, who's a member of the advisory board of the Journal of Investment Management Conference series. But in his day job, he is the Chief Investment Officer of Vanguard, and as Chief Investment Officer, he's responsible for the oversight of about $1 trillion managed by the Vanguard fixed income and quantitative equity groups. He got his BA from Dartmouth and his MBA from the University of Chicago in finance. He is a past member of the equity markets committees of the Investment Company Institute, and he also has served on the trading committee of the Securities Industry Association, Securities Industry and Financial Markets Association, and the AIMR Best Execution Task Force. So you can see all these participants are very much into the details of this subject. In favor of the transaction tax on financial transactions, Dean Baker is a widely quoted economist here in town. He got his PhD in economics from the University of Michigan, He is presently co-director of the Center for Economic and Policy Research in Washington, D.C. He has his own programs on the internet. His blog, Beat the Press, features commentary on economic reporting, and his analysis appeared in many major publications, including the Atlantic Monthly, the Washington Post, and the London Financial Times. He's written several books, one called Taking Economics Seriously. It's really an attempt to clarify the principles of economics and, as he put it, to take away the ideological blinders off of basic economic principles. He's the author of False Prophets, Recovering from the Bubble Economy, one of the earliest economists to predict the housing bubble collapse, and he walked the walk. He sold his house and rented an apartment here in Washington, D.C., before the collapse. He also predicted the market meltdown. He's the author of a book that needled the other side called The Conservative Nanny State, How the Wealthy Use the Government to Stay Rich and Get Richer, as well as the book that he co-authored with Mark Weisbrot called Social Security, The Phony Crisis. He is also author of Getting Prices Right, The Debate Over the Consumer Price Index. He's worked as a consultant to the World Bank, the Joint Economic Committee of the U.S. Congress, and the OECD's Trade Union Advisory Council. So we'll start now with the debaters, and will the moderator, Dean Baker.
Okay, maybe you should both get up here so we would, okay, thanks, Ralph, and thanks everyone for coming here. What we've arranged, I don't know if we had a coin flip or some random assessment, but we're going to have Bob start out with a brief case arguing for a financial transactions tax, and Jim having the same amount of time, 5 to 6 minutes, arguing in the opposite direction. So, Bob, you ready to go?
Yeah, well, thank you, Ralph, for organizing this. We were talking before the event. We'd actually done one of these about a year and a half ago, so this is like the Ali Frazier fights. So this is the second one. Wait for the third one. We're gonna do it in Manila for those of you that are boxing fans. Well, Ralph gave a lot of the introductions that I was going to give, so I can speed over some of it. The idea of a financial transaction tax is a small fee paid on every financial transaction. For example, if you set a tax on stock trading at 0.5%, and you could divide that among buyer and seller, so it'd be 0.25%. If you have a $100 trade, then each trader would pay 25 cents. Now, Dean and I have actually worked with a tax, financial transaction tax at that level for stocks, and then we scaled the values, and we can get into details later if you want, for bonds and all derivative markets, including options, futures, swaps. And what we've calculated is that you could raise about $175 billion in today's financial market per year, assuming that you cut trading by 50% in an implausibly high level of trading. Now, we may be off a little bit with our calculation, but the basic numbers are there, and I'll give you some evidence on that in a little bit. $175 billion would be enough to fully cover the entire deficits of all the states that are now facing austerity budgets today. Fully cover for fiscal 2012, so that rather than hearing news stories about cutting teachers' pay, cutting nurses' pay, cutting health care, shutting down the state of Minnesota, and maybe shutting down the United States, we could talk about expanding opportunities and services, and on top of that, we could fully pay for it, and then we would still have $90 billion left over to expand investments in, for example, the green economy, strengthening small businesses, and job creation. Now, as Ralph said, the tax is equivalent to a sales tax or a gambling tax. In this city of D.C., the sales tax is 6%. So if you spend $100 here in Washington, if you go to Home Depot and do something useful like buy caulking equipment to retrofit your windows, you would pay $6 tax for the $100 of expenditure. But if I buy $100 in stocks tomorrow, I'd pay no tax, zero. If I go gamble on Wall Street in Las Vegas, I'd pay 6.75, or the owner of the casino. Now, the tax can be used for two distinct purposes. It can be used to raise revenue, as I just described, and it can be used to reduce the size of the speculative financial markets. Now, the beauty of the tax is that if you are in the market to buy and hold, if you have a long-term perspective, the tax is negligible. So if you buy $100 in stock and hold it for a year, you pay 25 cents in the way I've described the tax. If you buy $100 in stock and turn over your portfolio every week, you're going to pay $12.50. So the tax does become onerous if your strategy is to keep trading all the time. Now, you can design the tax, make it higher or lower, according to whether your primary purpose is to raise revenue or to discourage speculation. You can also try to kind of hit a sweet spot between the two. The tax is very flexible in that sense. Now, why are we talking about the tax now, other than that Ralph Nader had the idea to organize it? Obviously, as a result of the massive financial crisis of 2008 and 2009, which left the economy in the most severe recession, and we still really haven't gotten out of it. I just heard the new unemployment statistics, 9.2%. For the narrow measure, if you include underemployed, it's about 16%. That's about 25 million people. 25 million people. And it sounds like a number, but imagine all the entire population of the biggest 10 cities of the United States. That is New York, Los Angeles, Chicago, Houston, Phoenix, Philadelphia, San Antonio, San Diego, and Dallas. Imagine all of those people. That's less than 25 million people. That's how many people in this country are unemployed or underemployed. In addition, we of course know about the massive bailouts to the financial markets who created the mess in the first place.
About 1 minute.
Okay. The International Monetary Fund estimated even after the money the banks have paid back a considerable portion, there's still about $500 billion that has been unpaid. Now, I don't have much time for this initial statement, so I'll just make a couple of quick points. The crisis that we've experienced is no aberration in terms of financial markets that are unregulated, having created multiple crises over the last generation tied to the deregulation of the financial markets. Other countries are running financial transaction taxes. The UK has a financial transaction tax now, roughly in the way I've described it. Japan operated with a tax until 1989 and raised about 4% of all their revenue. Okay, okay, I'll stop there and we'll come back. Thanks.
Okay, thanks, Bob. Okay, now Jim Angel's going to tell you why Bob was exactly right.
Or not.
Or not.
Well, I want to thank everybody for coming here for this very interesting and timely debate. First of all, let me get a sense of who's in the audience here. How many of you have a mutual fund or a retirement account? Okay. How many of you have a mortgage, car loan, credit card, other financial product? How many of you have a bank account? Okay. So I see that almost everybody in the room here is a consumer of financial products. You're the people who are going to get hit by this ill-proposed tax. But this is a tax proposal, so let's start at the beginning by asking ourselves, what do we want from a tax system? Now, if you look at tomes on public finance, there's always a section on how you evaluate tax alternatives. First of all, you want a tax that's going to raise revenue. I mean, that makes sense. But you also want one that's easy to administer, that does not impose enormous compliance burdens on the government to try to collect it and on the people you're trying to collect it from. You also want one that minimizes the economic distortions that a tax causes. So, in other words, when you tax something, people try to avoid the tax in some way, or people stop doing whatever you're taxing, and you want to avoid distorting the economy. Furthermore, you want something that's fair, where people are paying their appropriate share of the tax burden, where the pain is distributed appropriately to the people who should bear the pain. And we can always debate on that, because everybody always wants somebody else to have the pain. And there are other goals as well. Some people want to use the tax system to redistribute wealth. Some people want to suppress undesired activity, like smoking or taxes on tobacco. Sometimes you just want to punish people we don't like, or just make other people pay. Okay, so this is what some of the goals of taxation are all about. And when you look at this proposed tax, what you see is it fails in virtually every single one of those dimensions. It is not a free lunch. It will not raise hundreds of billions of dollars. What it will end up doing is not hitting Wall Street. It's not going to get the people who brought about the financial crisis. They're not the people who do the most trading. Turns out the people who do the most trading actually are some of the most beneficial players in the markets. They're not frothy speculators causing excess volatility. No. When you study financial markets and actually look at the people doing most of the trading, most of them are doing very small technical things for very small profits, and they're doing things that help you and me. So the problem is, this tax misses its target. It doesn't really get the fat cats. What it does is it's going to be passed right on through to you and me. And that's one of the reasons why I just don't like the tax. There are plenty of other problems with the tax. We used to have a financial tax, transactions tax, much, much, much smaller than the one being talked about here. The one being talked about here is roughly 10 times larger than what we got rid of in 1965, and 20,000 times larger than the current SEC tax. And let's look back at the lessons of history. Back in 1965, Congress looked at the old tax, and in an overwhelming bipartisan vote, they said, this kind of taxation is a bad idea. And they weren't really in a big tax-cutting mood either. I mean, if you go back and reread the congressional debate, the congressmen were well aware of the impending funding needs of the Vietnam War. But they still looked at the tax and they said, it's a bad idea. When you look at other countries that have put in such a tax, places like Sweden, they put in such a tax, and whoa, all the financial activity went offshore, and they didn't get nearly as much money as they thought they were going to get. So they got rid of the tax. So this is a bad idea that we got rid of before, and even though each generation should think about taxation, there are plenty of better ways to raise needed government revenue. So when you talk about the reducing speculation, again, the people who trade the most are not speculators. And if you look back in the past when transaction costs were higher and when we did have these kind of taxes, there was plenty of speculation. If you look in our recent history, where did we see the worst speculation? In the housing industry, where transaction costs are enormous. Typically, when you buy or sell a house, the cost of doing that eats up about 10% of the value of the house. Did that stop people from speculating? No. The speculators aren't going to be stopped by a tax of 1/4 or 0.5%. What you're going to do is you're going to get rid of all the beneficial trading that make things work more smoothly. So the transaction tax is a bad idea. It misses its target. It won't raise the revenue they say it's going to raise, and it's not going to punish the people they want to punish. All it's going to do is mess up the good things that the financial markets do for the economy. Thank you.
Time. Okay, Gus will lead a round of questioning back and forth. Oh, I'm sorry. Okay, glad you got it. Someone here has a script. Okay, I'm sorry. Bob will go first, summarizing for 2 minutes. I read ahead.
Okay, some responses. Jim said it won't raise hundreds of billions of dollars, but we have evidence that it does. We have the evidence from the tax in the UK that's operating right now that's raising about what would be the equivalent of about $40 billion in the United States, only taxing stocks. The tax is actually easy to design and easy to administer. The IMF recent paper on the issue acknowledged this point. Economic distortions. I want to cite some quick numbers here. From the decade 1970 to 79, for every $1 of productive investment by non-financial corporations, there was $1.30 worth of trading. This number zoomed up in the 1980s. For every $1 of productive investment, there was $4 of trading. The year before the financial crash, 2007, so we had a jump from $1 to $4. Guess what it was in 2007? For every $1 of trading, for every $1 of investment, there was $36 of trading. We went roughly 1 to 1, 36 to 1. There's been a massive, massive increase, and that's just the stock market. So trading, what Jim is talking about, huge turnover in trading has overwhelmed the financial markets, and it has not contributed at all to any increase in productive activity. The rate of growth of productive investment is actually lower over the decade of the 2000s than it was in the 1970s. Congress said it was a bad idea. Well, Congress also said that deregulating financial markets was a great idea. Remember that? That was both Democrats and Republicans. We got rid of a regulatory system that was working reasonably well, and we ended up with two decades of financial crises culminating in the 2008-2009 case.
Okay, Jim, you got 2 minutes?
Yeah, you mentioned the UK tax. I think that's a classic example of how not to do a tax. And yes, it does raise some revenue, but simple and easy to administer. I downloaded off the internet the manual, the compliance manual for the UK stamp tax. It's 320 pages of dense fine print. It is certainly not what I would call a simple or easy to administer tax. And you know what? It exempts most of the financial professionals. The folks in the UK aren't dumb. They realize that, finance is a big industry there. So it basically is all designed to tax the end user, the end investors, people like you, the people who have your retirement savings in a retirement plan. You're the folks who end up paying a tax like this. So if you want a UK-style tax, you're not screwing Wall Street. What you're doing is you're screwing the consumer. So I would say the UK tax is a really bad example of it. And by the way, the proposals that have been put forth in the US Congress look nothing like the UK tax.
Okay, great. Okay.
Well, I would like to thank Ralph Nader for sponsoring this presentation today, and thank you all for coming and welcome you to the debate. Just as a level set, I do come from the mutual fund industry, and there was some confusion initially when this tax was being described that perhaps mutual funds were exempt from this. Investors investing in a mutual fund do not pay the tax, but the funds themselves, when they buy a security, buy a stock or sell a stock, they would pay the tax. So 90 million investors in mutual funds would be indirectly paying a rather substantial tax. It would have, if applied in 2008, it would have been about $35 billion worth of tax that individual investors would have paid through their mutual funds. So there are three stated objectives of of this proposed bill, this transaction tax. The first is to tax Wall Street. The second is to curb financial market speculation, and the third is to raise revenue. And I'd like to tease out each one of these issues. Some of them have been described already. But first I'd like to start off with, is this a tax on Wall Street? So who does pay this tax? Is it investors, or is it the stockbroker? Is it Wall Street? And if it is Wall Street, partly, if it's levied directly against them, partly, is there any reason to expect that they're not going to pass that through, pass their costs through? So, Bob, you want to take that first?
The tax, like any tax, has ramifications beyond the immediate payment. Now, the actual payment of the tax, for example, as Jim mentioned, there is a tax already. There is a securities transaction tax administered to finance the Securities and Exchange Commission. And the actual payment of the tax is done by the exchanges. Now, the exchanges then pass the payment back to the brokers, and the brokers, may incorporate into the fees they pay that they charge their clients. So there's pass-through. Of course there's pass-through. We could say that there's going to be pass-through when there's a financial transaction tax, then the dealers, the brokers might charge it back to their clients, who then might put it into their business expenses. But, that's also true with any other kind of tax. I mean, like we say, when we pay a 6% sales tax at Home Depot or at McDonald's, McDonald's is calculating that tax rate. They may decide to try to pass it through to you. They may try to absorb it. Now, the immediate point, though, is like, who is actually paying for the tax? It's the people that are doing financial transactions. That is mostly, yes, there are small-scale investors, a lot of them. But mostly, who is trading on Wall Street? Where is the big money? The big money is wealthy individuals, big businesses, and pensions. And you say, oh, well, yes, well, pensions are middle-class people and so forth. That's true. But the biggest holders of pensions are also the wealthiest people. So the immediate payment of the tax falls disproportionately, as it should, on the people operating big time in financial markets. Do we know how much the pass-through will be? You don't have evidence on that, and neither do I. Thank you.
Jim, would you like to address this?
Sure. The people who do the most trading are the people who make the markets work. And yeah, that is the basic misunderstanding of the proponents of the tax. So I'm going to get probably a little technical here to describe who's doing the most trading. Okay? That these are people who generally have their computers programmed to look at the prices of different related instruments. That's something we call arbitrage. And when they get out of line, they buy something that's cheap and sell something that's expensive, and that push the prices of related instruments back where they should be. For example, in my retirement account, I buy a thing called an exchange-traded fund, an ETF, which is a basket of stocks. It's the Vanguard Total Stock Market Fund, ticker symbol VTI. It's my standard recommendation for everybody. Okay, now, what it is, okay, it basically represents the whole U.S. stock market. So I don't have to think about, what's good, what's bad. It just gives me the whole market. Okay, now, that trades on an exchange like any other stock, but it represents every stock in the country, more or less. Now, there are people out there, they have their computers programmed, they look at the price of that VTI, and they look at the price of the stocks that go into it, and when they get out of line, they buy the cheap thing, pushing up its price, sell the expensive one, pushing its price down, and they hope to make, like a half a penny a share profit on that. Now, that means that when I go to buy some VTI from my retirement account, its price reflects the price of all the stocks that go into it. That's a good thing. That arbitrageur who is, sort of going in and out, just sort of trying to make a little bit of money off those differences in prices, making sure that I get the fair price for the thing that I'm buying from my retirement plan. And to be continued.
So I'll ask another question: is if investors are actually going to pay this tax to some extent, if not largely. How big is this tax to investors? We know that it's 0.25% or 25 basis points.
Well, he just said 50.
Well, on the other side.
On both sides, 25 for each side.
Yeah.
So if the direct tax to the investor is about 0.25%, the average mutual fund turns over about 100% a year. So that means that the mutual fund will lose about 0.25% in performance. But then there's also a secondary effect as well. The proposers of this bill indicated they thought transaction costs would decline, would increase back up to the levels they were 20 or 30 years ago. That's an increase of about 1%. So another increase of costs for the mutual fund on 100% turnover, that's another 1%. Jim, can you discuss what you think the cost might be?
Sure. That investors expect a certain level of return. So what's going to happen is if you raise transaction costs up to where they were 20 years ago by 1%, and if you figure the average mutual fund turns over their portfolio about once a year. These are the people who are investing on our behalf, trying to make the right decisions for us. So that's 1% a year. So if you think about it, 1% a year compounded over 20 or 30 years to retirement, that's basically 20 or 30% of your retirement savings going to this tax. So it actually is a big hit when you compound it over time. So and it's going to hit long-term investors, mom-and-pop investors, people in mutual funds, or if you've got a pension plan, an old defined benefit plan, it's going to affect the returns to those plans.
Bob?
First of all, the tax that we proposed is 0.25 on stocks. And we then scale it down for other types of assets, including bonds, swaps, options, and futures. And our work on this is fairly common. So it's not actually an accurate calculation that he made, because your entire portfolio is not just going to be stocks, of course. So the number is actually much smaller than what Jim just described. But be that as it may, I mean, the notion that there are costs that people will actually not have as much money because they pay their tax is obvious. I mean, there's really nothing to debate around that. But by the same token, I mean, again, why should we pay a sales tax? If I go to Home Depot, I would rather spend $106 for things that I want rather than $100. Now let's compound that over time. That's going to be a lot bigger than your compounding exercise, because that's a 6% tax, not a 0.25% tax. So, we have to compare apples to apples here.
Okay, thank you, Bob. I would note that if the fund itself is going to incur taxes of about 1.25%, either through transaction costs being higher or through the direct imposition of the tax, that a saver or an investor I use mutual funds as an example all the time, because that's where most of America does save, 90 million savers. If they were saving at 9%, and all of a sudden, if they were earning 9% on their equity investments, and it would reduce by 1.25% down to 7.75%, 30 years later, their investment would be worth 30% less than it would have been without that tax. So it is a game changer for millions of Americans who are saving for retirement. Bob, what are your thoughts on that? Is this still a small tax?
Well, okay. The point is that your assumption is that financial markets operate efficiently on their own, and that all this is an imposition on an otherwise efficient process.
He never said that.
What?
He never said that.
I said the assumption. Here, the fact is, our society, economy, has just paid a gigantic cost because we operate hugely inefficient financial markets. The process that we're describing, the short-term trading, does not create any social benefit. I mean, the notion of people sitting around and trying to guess an hour ahead of everyone else and having experts to tell you what you should be doing 2 hours ahead of everyone else does not enhance the long-term productivity of the economy. Moreover, the kinds of things that we are deprived of doing because we don't have revenue coming in, for example, that we're having to cut education budgets, that we're having to cut healthcare budgets, that we're talking about breaking pension funds for state workers throughout the country, that the state of Minnesota is out of cash. These are the kinds of trade-offs that one has to think about. A tax is a tax. It does impose costs on the people that pay the tax. But this tax is disproportionately on the people who are better off. It engages with the activities on Wall Street and only sets them at a level comparable to what one sees when you buy anything. In fact, it's not comparable. It's a much smaller tax. The tax does have to be scaled relative to existing transaction costs. I agree on that point. In fact, a lot of the research that we've done is to try to understand how to do that and to set the tax at a level consistent with transaction costs. And that's what we've done in this paper. And that's why, as I said, the tax rate should be lower for bonds. It should be lower for options, futures, swaps.
Thank you, Bob. Jim? Yeah.
So you've raised the issue of we pay sales taxes, so why shouldn't we pay taxes on transactions? Well, in general, we have several different levels of taxes. You know, we tend to tax wealth with things like property taxes. We tax profits with income taxes. And we tax consumption with things like sales taxes. Now, we don't have a federal sales tax, for one thing, and I kind of like that. But, you know, the argument for consumption taxes is that basically you want people to produce more, consume less. Now, trading is actually an intermediate good. You know, it's not like we wake up in the morning and say, wow, you know, I'm going to consume 5 stock trades today because I get this joy out of moving electrons around. Well, maybe some people do, but I don't. Once again, he's missing the target because most of that high-frequency trading is actually the most beneficial trading around. These are people who support the ecosystem. Now, you might say, now, how could it possibly be the case that somebody who's buying 1 second, selling the next is doing a service? Well, as I said, I'm a long-term investor. You know, I buy my VTI once. It sits in my account for decades, I hope. And guess what? The person I'm buying it from is probably one of those real short-term traders who make sure that the gap between the buy and the sell price is really small. Because at any time in a market, there are people trying to buy, just like eBay, and there are people trying to sell. And oftentimes there's a gap between the price at which the buyers are trying to buy and the sellers are trying to sell. Well, what those high-speed traders do is they try to go in between and they narrow that gap so that it's now razor thin. If you put on a tax, you know, thousands of times higher than current transaction costs, what you're going to do is you're going to drive a big wedge between the buy price and the sell price, and every time you go, okay, to be continued.
I'd like to turn to a topic that has been discussed already, speculation. So the second goal of this proposed legislation is to curb speculation, and I'd like to first talk about what speculation is. Speculation is taking a non-trivial amount of risk, typically higher than ordinary risk, to make a higher than ordinary rate of return. And you know, so Jim's described something where people trade, high-frequency traders, they trade 1 second and then they trade another second. They buy and then they turn around and sell, maybe to make a fraction of a cent. Is that speculation? Really, 2 great examples of speculation would be speculation in the housing market that we saw through 2007, and then speculation in the stock market in 1999. I'd like to ask, will a transaction tax actually curb true speculation? Jim, you want to take that first?
No, because, again, the people who are doing the most trading are not speculators. These are people who are taking very small trades for very short periods of time, and they're doing things that help the market. Now, you know, you might say, ooh, some bacteria are bad, so let's eliminate all bacteria on the planet. You know, that's, you know, what I think I hear here. Now, oh, trading is evil? No. Yeah, sure, there are some speculators out there, but they're not doing the most trading. Most of the trading is done, you know, by the beneficial players on the market. So if you eliminated all bacteria on the planet, you'd be eliminating, the ones that, help, ferment cheese and beer and things like that and bread, as opposed to, as well as getting rid of the ones that cause disease. So we need to make sure that we are not missing the target, which you are. You're missing the target. Most trading is actually done by people who do things that help long-term traders. People like me, people like Gus here. He has a very low turnover in his funds. And yet, when he goes to trade, the fact that there's an ecosystem of people out there willing to trade with him at a good price means it's a lot easier and cheaper for him to trade. So, a transaction tax, is not going to really deter the speculators because, they're in it for the kill. A 0.25%, 0.5% won't stop them. If you look back in the days of old when transaction costs were very high, you still had plenty of speculators. What the decrease in transaction costs has done is it has helped create that ecosystem of people who make trading work better. And people who make sure that the price of that when I go to buy that exchange traded fund, it's properly priced. That when Gus goes to buy stocks, for his customers, that the gap between the buy and the sell price is really small. That is a beneficial activity.
Okay, thanks, Jim. Bob, do you have a comment?
I'm not clear as to why we assume that increasing the level of trading on stocks alone, and again, stock trading is actually a small proportion of overall trading. But just thinking simply about stocks, of increasing it 36-fold relative to in productive investment. The thing that drives the economy forward, that creates jobs and innovation, is productive investment in equipment, machines, computers. So increasing the level of trading 36-fold relative to the 1970s, I don't understand why that has been such a great benefit to the economy. I don't see any evidence. In fact, the evidence is that it has led to excessive focus on these short-term differences, which I see as actually a net loss to society because we're wasting a lot of time on trying to exploit these tiny differences as opposed to achieving some long-term benefit to the economy. And we've talked a lot about the Vanguard Fund, and I want to quote from John Bogle, who was the founder of the Vanguard Fund, and maybe at some point your colleague. Here's what he says about the securities transaction tax. I support a transfer tax on securities transactions, primarily as a way to slow the rampant speculation that has created such havoc in our financial markets, but also for its revenue-raising potential in this time of staggering government deficits. That's John Bogle, the founder of the Vanguard Mutual Fund that you two have been referring to.
Well, thank you, Bob.
He's your boss, or was your boss, right?
So I worked with Jack for a little bit more than a decade until he retired. Continue to have contact with him, and there are a number of things that Jack and I don't agree on.
Apparently.
And I'll leave it at that. If this transaction cost is going to definitely take return away from investors in the form of the direct tax that investors will pay, and also in the form of higher transaction costs, what's the impact on the cost of capital, raising capital? Businesses need to raise capital in order to build their businesses, in order to hire more people. What's the impact on the cost of capital? Bob, you want?
Yeah. Cost of capital. Now, again, let's not think in technical terms so much. So we're talking about interest rates, taxes, and so forth on businesses that want to invest or consider investing. At one level, of course, it has to have some impact on increasing cost of capital, probably by a small amount. But the effects on the cost of capital of this tax are going to be overwhelmed by other things. For example, right now, the interest rate on short-term borrowing by banks set by the Federal Reserve is effectively zero. The Federal Reserve has the ability to determine the short-term interest rate and will do so no matter what happens with the securities transaction tax. Now, what about rates on longer-term activity? Now, right now in the economy, and this would be a topic for another debate, the spread between this zero rate that banks can get and the average business borrower is at almost unprecedented levels. That's due to risk perceptions in the economy, the perception of excessive risk brought on by the Wall Street crash and its aftermath. So if we run an economy that is operating at a higher level of stability, that does not focus so obsessively on these tiny little differences that interact day to day, minute to minute, if we operate in an economy that is more focused on productive activity and productive investments, we lower the level of risk and risk perception, and that way you have a longer term and more stable effect, lowering the cost of capital than you would through the effect on the transaction tax alone, operating on the cost of capital.
Thank you, Bob. Jim.
The problem is the tax misses the target. As I pointed out, most of the trading is not done by speculators, not done by people who are, adding volatility, but by people who are stabilizing the system. When, as I said, you've got buyers with a low price, sellers with a high price, a lot of these traders tend to come in between and actually absorb some of the shocks in the system. They're the ones doing the most activity. They're the beneficial players that would be driven out of the business. Now, let's talk about the role of the financial markets. I see a lot of nurses here, and I want to thank you for taking such good care of my son when he was in the hospital. But where do you think the money comes from to build the hospitals? Generally speaking, most hospitals go to the financial markets, sell bonds, and investors want to buy those bonds. Well, investors are more likely to buy those bonds if there's a market where they can sell them when they want to cash out. And that secondary trading afterwards makes it much more likely that people will buy those bonds in the first place. So saying what good is the fact that people buy one second, sell the next? What they're doing is they are providing a service that help the long-term investors when they want to come in and buy and sell. So that's where you're totally missing the boat with this proposal, because most of the trading is done by people who are doing things that help investors, that help long-term price stability, that putting this tax on really won't stop the speculators. It won't stop the people who are hearing reverberations from the planet Mars and saying, oh, I'm feeling lucky today, I'm bullish on Google. No. Those people won't be stopped by this tax. Those are the people that add the volatility, the uncertainty. That what you're going to do is you're going to cause so much collateral damage that you're missing the target.
Well, time flies, and unfortunately mine is gone. Hopefully the discussion around raising revenue will be picked up, and there has been some discussion about that already. Would you like to take over?
Okay, thanks, Gus. There's an old sport in Washington where, when we talk about tax increases, I always find the most vulnerable person, most sympathetic person. So, for example, there's been a big debate on, of course, extending the Bush tax cuts for the wealthy, and the cutoff that President Obama's put there is $250,000. So naturally, the poster children, and the Washington Post, which we know here is Fox on 15th Street, had a front page piece about this woman who's supposedly earned $260,000. She's going to be paying the higher tax. You're supposed to go, oh, that's horrible. She's not really rich. Well, guess what? Her tax bill is going to be $300 a year. If she's making $260 and can't figure out how to get $300 a year, she has more problems than the tax. And I think that's kind of the story here. Guaranteed that if we have this tax, some people who are not wealthy will be paying that. That's the world. But the fact is that the vast majority of people who do pay the vast majority of the tax almost certainly will be wealthy. That's kind of straight arithmetic. There's another part of the argument here that's very, very important to understand. I don't think we get a difference, and Jim will tell me in a moment whether we would, but I don't think we'll get a difference between Jim and Bob on this, because it's well-known economic principles. There's an idea of elasticity, that people respond to the tax. So we impose a tax, and let's just say that we double the cost of trading. And as Jim pointed out, trading is an intermediate good. It's not I wake up in the morning and go, hey, I want to do a lot of trading. I might get up in the morning and go, oh, I want to have a really good breakfast, or I'm going to buy a new suit. I probably need a new suit. Those are end goods. We get value from that itself. What we care about with trading, the whole point is that at the end of the day, we care about our investment income. Now, if we get the same investment income but we have less trading, what's the problem? Okay, we care about the investment income. Now, there's a lot of research or I shouldn't say a lot of research, there's some research that Bob and I, I'm sure Jim's familiar with it as well, have looked into that examines the elasticity. How does demand, how does trading respond to an increase in the price? Most of it puts it around 1. What does that mean? Suppose we double the price of trading, as Bob and I have roughly proposed to do with our tax. Well, this research implies that the amount of trading that you would do would be cut roughly in half. So let's just take some numbers here. Let's say that I have $100,000 in my mutual fund over with Vanguard. Great fund, good choice, paid advertisement. $100,000, and let's say that, it turns over 1% a year, which it doesn't. They have lower costs than that. But let's say it turns over 1% a year. Okay, that would be $1,000. Now let's say, Bob and I take over the government, we put in the tax, we double the cost of trading. Okay, well, we got smart people here. He goes, well, it costs twice as much to trade. We'll trade less. We'll cut our trade roughly in half. That's what the data shows. Okay, so it costs him twice as much to do the trades. He's doing half as many trades. Okay, Jim, give us the arithmetic. How much did trading cost increase for me with my $100,000 in Gus's fund?
Okay, well, it's a lot more because not only is the tax going up, but by driving out, the people who are making trading cheaper, you're going to raise the bid-ask spread, so you're going to raise transaction costs not only by the tax, but also, you have a number of knock-on effects in that you also have the wider trading costs. Now, that's going to increase cost of capital for businesses, and what that means, it's going to be harder for people to raise capital in the first place. And that's going to have a knock-on effect on the economy in terms of things like fewer jobs, less economic growth, more unemployment.
Okay, Bob.
Interesting that that you would say such a thing amid the financial crisis caused by financial excesses on Wall Street, which we're experiencing now. That's the reality today. It was excessive speculation that brought the economy down, and we haven't recovered yet. Now, Dean is exactly right. If we think about transactions costs, if you lower the total number of transactions through the tax, yes, the cost per transaction is higher, but if you reduce your total number of transactions, then there's no increase in total transactions cost. None whatsoever. Now, you could say, yes, but there's all these negative effects. And Jim just mentioned them. That hospitals won't be able to raise any money to build hospitals, that unemployment is going to go up, and so forth. Well, he, of course, has no evidence to support any of those points. We do know that hospitals are closing now. We do know that nurses are getting laid off, that we do know that pensions are getting attacked. Why? Because we don't have enough revenue because of the financial crisis brought on by Wall Street. The financial crisis brought on by Wall Street devastated state and local governments, and we're talking about raising funds for municipal bonds like hospitals. The crisis dropped revenue for state and local governments by 13%. There hasn't been anything even close to that since the Great Depression. In the 1981-82 recession, the most severe one prior to this one, state and local government revenues fell by 1%, 1 to 1.5%. Now we're at 13%, and that's what's causing all this, destructive politics in Minnesota, which was supposedly a very civilized place up until the crisis. So that's the reality we're dealing with today.
Okay, I just want to go on. We've had this back and forth about finance being an intermediate good, and I think that's a really, really important concept to understand, because the idea of an intermediate good, again, it's not providing us, well-being, whether understood or misunderstood. Cigarettes, obviously, we might say someone's mistaken if they're buying them, but in any case, they think it's providing them well-being. People don't typically think of stock trades as doing that or financial trades as doing that. So when we think of it from the standpoint of the economy as a whole, in principle, we'd like this to be done as efficiently as possible, meaning as small a sector as possible. And if you look, and here I'm just talking about very narrowly, the sector devoted to stock trades, trades of commodities, trades of options, futures, that segment as a share of the economy has increased roughly 5-fold from the 70s. So I'm talking about relative to the size of the economy. So currently that narrow segment, I'm not talking about going down to the bank in your checking account, I'm not talking about your real estate agent, I'm talking about this very narrow section, commodities trading, security brokers, investment banking, that's increased 5-fold. So it's now about 170, 180 billion a year. Now, I think the way I would, at least would think about that is that that's similar to the trucking industry. Suppose we had the number of truckers had increased relative to the size of the economy fivefold over the last 40 years. My guess would be that most people would be inclined to say, what's wrong with your trucking industry? Is there some evidence that, the goods are getting from point A to point B quicker? We're getting our meats fresher, our foods fresher. Are we getting something from that? I look at the financial sector and I go, okay, it's increased fivefold relative to the size of the economy. My first guess is, that looks like 180 billion or maybe 150 billion. That'd be 30 billion if, it stayed constant as a share economy. That looks like 150 billion of waste. What do you think, Bob? Is it? What do you think, Bob? Is it?
Good question. Well, yeah, this is the point I made before. The level of trading has exploded to an unprecedented degree as a result of financial deregulation. And the outcomes, if we want to talk about basic outcomes, in terms of financial stability, we're much worse off. Much worse off. And I'm not just talking about the most recent crisis. Remember, there was the dot-com bubble that burst and created. Before that, we had the savings and loan crisis that cost the taxpayers hundreds of billions of dollars. We had the collapse of long-term capital management as a result of the global East Asian crisis. Long-term capital management was supposed to be the top wizards, 2 Nobel Prize laureates in finance, cooked up long-term capital management because they, like Jim, they supposedly knew where those hidden pennies were. And they knew how to deal in the markets better than everybody else. Well, that tanked the economy as well. And what has kept us afloat has been the bailouts, one after another. 1987, Wall Street crash, and at that point we had a bailout by a new head of the Federal Reserve, Alan Greenspan. Alan Greenspan subsequently himself has talked about the imposition of irrational exuberance in the markets and infectious greed in the markets. Irrational exuberance and infectious greed is exactly what Jim is talking about when people trade excessively in order to earn earnings off of tiny differences that aren't going to last anyway. And there's no reason why we have to assume that the level of trading has to be hundreds of times today what it was only 15 or 20 years ago in order to achieve outcomes in terms of stability, employment, well-being, things that we actually care about.
Jim?
Well, you said the financial sector is bigger than it was a few decades ago. Well, so is the healthcare sector, and so is the computer sector. Now, one of the reasons the computer sector has gotten bigger is we had a technological revolution, and we can now do a lot of things we couldn't do before. The same thing happened in financial services. We've had a technological revolution of new products, new services that allow us to do things we couldn't do before, in particular with risk management. So, for example, suppose that you're a farmer and you're thinking of planting a field, but because prices are fluctuating, you don't know if you can afford to do that because if the price drops at harvest time, you might go bankrupt. But you can enter into a financial transaction called a derivative that allows you to lock in the price at what you're going to get for your crop when you sell it. Okay? Now that you know that you'll get a fair price for your crop, you can afford to plant the field. You've laid off the risk. You've transferred that risk to somebody else, even if that somebody else is a speculator. The market's developed a number of new risk management tools, and we can now do a lot of things. Now, are they perfect? No. Does every new technology work perfectly? No. Sometimes airplanes crash. Sometimes bridges fall down. Sometimes automobiles get into wrecks. And indeed, we did have a massive wreck in our financial markets, no doubt about it. Do we need better regulation? Yes. It's not a question of more or less. It's a question of smarter regulation. And by the way, the government has not fixed it with Dodd-Frankenstein. There's a lot of work that needs to be done there. That doesn't mean that just because sometimes an airplane crashes that we need to get rid of airplanes. Instead, what it means is we've got to figure out why they crashed and make sure it doesn't happen again.
Bob Eckler.
You kind of took my breath away with your reference on the farmer. The derivative market for food, the futures market, actually has been around since the Bible. So this is not a new invention due to technological change. And you described exactly well what has been also described in the Bible, wherein farmers are able to get a fixed price and they can plant their crops, and they don't have to worry about what the price is going to be 8 months from now when their crops are ready to harvest. That actually has nothing whatsoever to do with what really is going on in the speculation in the commodities futures markets for food, wherein the prices 2008 and 2009 doubled, causing, according to the United Nations, 130 million more people to become malnourished because their livelihoods are, their spending is 50% on food. So when you double the price of food, you will increase hunger throughout the world, and that is exactly what happened as a result of the unregulated, rampant speculation on the commodities futures market. We are experiencing the exact same thing again. And, by the way, we're experiencing it also with petroleum, oil prices. I actually have a new report that just came out last week. What do we pay? As of May, we were paying $3.96 at the pump on average, and I calculated with my colleague James Hines, 83 cents of that was due to speculation. And I've been in debates about that. I can defend that position. There is no reason why we have to have a commodities futures market 300 times bigger than it was 20 years ago.
Jim, you want a quick response?
Sure. Trading is not leading to speculation. That, yes, if you look at markets, even where there are no organized commodities exchanges, we still saw a price spike in 2008. So for markets where you didn't have futures, you still had the same kind of bubble occurring. And guess what? We've had these going back to the times of the Bible. Sometimes people acting in crowds go crazy. Markets are not perfect. They have a strong incentive to get it right. They generally do a better job in the long run than governments do, but sometimes they make mistakes. The real question is, do you want, the real problem is, you point out all these problems with the markets. Your solution doesn't cure the disease. All it does is cause a lot of collateral damage.
Jim, it's surprising you'd mentioned that made the comparison of financial markets to healthcare and computers, and it's clear to me what the benefits have been from increased spending on healthcare and computers, a little less so in financial markets. I just asked people here, do you feel more secure in your savings today than you did, say, 20 years ago, 30 years ago, or your parents might have been, since I realize most of you probably weren't doing much saving 20 or 30 years ago. That's the question we have to ask. I mean, I don't mean that to be easily answered, but that's really, at the end of the day, the question to be asked. One of the points here, and again, I think it's important to put this in context, and we've already had some of this with Gus, so he made the point that we're talking about raising the cost of financial transactions back to what they had been. So we're not talking about, ancient history. We're not talking about, putting this huge tax. We might say it's huge. That's obviously sort of a value judgment. But we're talking about going back to charter territory. We're talking about raising the cost of these transactions roughly where they were in the early 90s, mid 80s. I mean, we'd have to look at that more closely. But that's roughly the target. And I find that important because, again, in the context of a lot of points Jim's making, and he's right, we care about arbitrageurs. They're not evil people. I mean, there's use in, you realize that these markets are out of line. There's use in bringing those into line. But arbitrage isn't new. I mean, I was in grad school in the early 80s, I guess mid 80s. We talked about arbitrage on that, and many of the papers that we were reading dated back from the 60s. In fact, James Tobin, the Nobel Prize-winning economist, who was a big proponent of financial transactions like what we're talking about, the first paper he wrote on this was back in 1971, when trading costs were considerably higher than what they would be today with the tax. And of course, John Maynard Keynes back in the 30s talked about a tax, when trading costs were considerably higher than what they would be today, even with any sort of tax that Bob and I might propose. So I guess what I'd want to ask is, Jim, we had transaction costs at this level in the past. You talk as though there'd be no arbitrageurs, but there were arbitrageurs there. So aren't we really just talking about an issue that the arbitrager jumps in maybe when there's a gap of 0.3 of a percentage point in the price, maybe then rather 0.1 of a percentage point in the price? And if that's the case, who cares?
question is, who cares when, prices get out of alignment? Well, I care in that, when I go to buy the VTI, the exchange traded fund from my retirement account, I want to make sure the price reflects what's going on in the underlying stocks. Well, on May 6th, 2010, we had a big glitch in the market. Long technical story. There were all kinds of problems that occurred. But one of the things that happened was, because of the technical glitches in the market, the arbitrageurs stepped to the sidelines. And we saw what happened when the arbs aren't there. The prices fluctuated wildly, and the price of VTI went all the way down to 15 cents. Now, it's normally a much more expensive item. That trade was busted after the fact. But if you get rid of this ecosystem, you're going to have less resiliency in the market. And in this computer-driven age, you may wind up with much more volatility, not less.
Okay. Well, I just say, in terms of the ecosystem, I agree. We want the ecosystem, but it seems to me the ecosystem was there in the 50s, 60s, 70s when we had much higher transactions costs. So anyhow, I'll let Bob jump in on that.
Yeah, you're a good moderator, Dean.
I try to be good. Neutral.
Well, yeah, the basic point is, what are the features of an economy, an economic policy, that will enhance productive activity, decent jobs, stability? Now, the kind of things that Jim are talking about, it actually have absolutely nothing to do with these long-term agendas. What they do is act as, at best, a distraction. But more specifically, what they really do fundamentally is, we're assuming that traders in the market really have full information and eventually are going to get to the right point through this arbitrage. Well, what we really know is that bubbles get formed because you have a bubble momentum where the upward price movement leads to other people thinking prices are going up. This is what was behind the increase in food prices. This is what's behind the increase in oil futures markets now, is that the fact of things going up does not mean that a speculator is going to say, okay, the price is off relative to the fundamental value, I'm going to drive it down. The speculator may well say, well, the price is going up and I can move it up further and make money that way. So there is no reason to assume that just having more trading is going to drive the price to stability. The prices are out of alignment precisely because there is excessive speculation. So much so that it is frequently the case that we can't even observe fundamental values. Again, look at the oil market today. If you look at the supply and demand relationships, supply and demand, actual supply and demand are growing together. Libya didn't change supply. Libya didn't change demand. Libya changed what people think what supply is going to be in the future, and that led to the increase in speculation. That is not a net benefit to society for the price of oil to be 83 cents more than it should be due to speculation.
I'll just get in one last word and then switch to the next phase. I mean, again, just to try to emphasize the point, at least the way I would see the point, and you'll get the first question in a second, but the way I would see the point, the question here is that we're talking about increasing these spreads somewhat between the buyer and seller, and that clearly, that I think no one would dispute, is one of the results of this tax. We're raising them back to a level that we saw in the early 90s, mid 80s, and I'll just raise one more point about this, because again, Jim raised a very good point about liquidity. We like, if I own, a share of stock, I want to think if I have to sell it tomorrow, I could do that. And obviously, if it's a somewhat thinner market, you're less likely to do that. To my mind, one of the nice features about this tax is that the proportionate increase in prices, transactions costs, will be much, much less on the less liquid assets. So what I mean by that is, suppose I own shares of General Electric stock, huge company, hundreds of millions of shares, maybe billions outstanding. If I want to sell General Electric stock, I could probably call my broker, do it any day of the week within, seconds, and I'll know almost exactly the price I'm going to get. Okay, now on the other hand, there are other stocks that are less liquid. Suppose I have an over-the-counter startup company and I want to sell that. Well, I can't just call up the broker and say, okay, sell this stock for me, and bingo, he's got a price for me. Well, the transactions cost in that stock are already much higher than with my General Electric. What that means is that the taxes that Bob and I want will be a much smaller share of those transactions costs. It means it'll have much less effect on the liquidity than it would on this already hugely liquid stock like General Electric. Okay, so I'll let Jim take the first shot at Bob and ask him a question.
Okay, so Bob, what you've done is you've talked about many of the problems in the financial sector, and you've proposed this tax, this basically for a number of reasons. As I see it, you want to raise money for good causes, and you want to punish bad people who brought about financial ruin, and also shrink the financial sector, which you don't seem to understand what it does. How much collateral damage are you willing to accept to reach your goal? Because your tax won't hit the target. Okay? The people who do the most trading are actually the beneficial people. The people who have committed the excesses that you talk about are really more low-frequency traders, that they're not doing the most trading, and so your tax isn't going to hit the target. So how much collateral damage are you willing to accept to achieve your goals?
Well, thanks for the question. I don't agree with the premises. I don't assume that it's not going to hit the target. I think that there are trade-offs in any economic policy intervention. And this one will impose costs, just like any other tax. And by the way, I don't think the people on Wall Street are evil. I never said that. In fact, some of my best friends, and actually many of my students, and many more of my students would love to be on Wall Street. So I don't have a problem with the people. It's up to economic policy to set the terms under which the financial market operates. I also don't have a problem with, as Dean described, with having markets that provide liquidity. Of course I don't. I never said I was opposed to that. The real question, the only really interesting question, is when do we have excessive liquidity, excessive trading, to the point that it distorts economic activity and well-being. And I want to cite a study by Larry Summers, who was the chief economic advisor for Obama, was treasurer.
Works on Wall Street.
And frequently works on Wall Street, and James Paterba, who is the president of the leading research institute, National Bureau of Economic Research, and professor of economics at MIT. Paterba and Summers did a very interesting study that was published in 1995 on the effects of excessive trading and speculation on the long-term decision-making of financial managers. And the study was actually an interview. They interviewed managers in the U.S. and in other countries. And the managers in the United States, according to Paterba and Summers, said that they would invest about 20% more in productive activity if they didn't have to be worrying over this day-to-day fluctuations in the market and having to achieve some performance on a day-to-day basis and get punished on a day-to-day basis. So, collateral damage. In fact, I think that the securities transaction tax, by no means a panacea, but will actually enhance long-term productive activity in the economy.
Okay, I'll give Bob a moment to formulate a question, but while he does, I just want to say a little bit about the issue of incidence, because we do have the model of the UK here, which again, obviously I think most people would agree has a pretty robust financial market, and the London Stock Exchange, I believe, is, we should get the rest of the tax code. Jim couldn't lift it, he's not big enough. But it has the largest stock exchange in Europe, or at least until recently it certainly did. They get the equivalent of 40 billion relative to the size of their economy. And in terms of the incidence, I know roughly about their wealth distribution. I don't know everything about it. But assuming it's comparable to the U.S., they couldn't possibly get that all from mom and pop people because they don't own enough stocks. So unless they're trading it, every day, there's no way that this could all come from sort of middle-income stockholders. A good chunk of that has to come from some of the wealthy, some of the people that we might think we'd want to pay the tax. Okay, Bob?
Okay, well, let's start with a provocative one. So if we assume that the tax, let's assume, economists like to say, assume this, assume that. So let's assume that the tax could raise $150 billion a year. And let's say that as a result of the tax, the level of trading went down by 15%. Okay? And then let's say that the funds generated by the tax would, as they would be fully capable of doing, supporting education, health care, public safety at the state and local government level, supporting environmental protection, and on top of that, we can throw in a middle-class income tax cut. Would you be opposed to the tax?
Yes, because I think there is a better way to raise needed government revenue. You know, when we look at taxes, once again, at the beginning, we need to think about what do we want from our tax system? Well, let's look at one of the biggest problems we have. Okay, we are addicted to foreign oil. We are addicted to oil. We are addicted to carbon-based fuels. You know, the amount of money we're sending outside of the country is enormous. It is jeopardizing our economic security. It is jeopardizing our national security. So, you know, one of our biggest problems is we've got to end our dependence on carbon-based fuels. The best way to do that is to impose a carbon tax. Basically, make people pay for using that non-renewable resource called petroleum. That, you know, it's not popular, but think about what it'll do. It'll give us an incentive to conserve precious resources. It will give us an incentive to develop clean alternative fuels. So, for our economic security, for our national security, for our climate security, we've got to stop guzzling oil. So if we put on a stiff carbon tax, what that will do is that will force us to conserve oil, it will force us to develop clean alternatives, and it will generate more than enough needed revenue for all the good things that we need to do.
Well, it's, you know, hearing this, and, you know, Bob wants to tax financial transactions, Jim wants to tax carbon. I want to tax everything, you know, but anyhow, no argument for me on the carbon tax, I got to say. Jim, do you have a question for Bob?
Well, you mentioned economist assumptions. And you named a lot of names of people, but one of the things I've noticed as you know, a specialist who you know, kind of wallows in the bowels of the financial system and hanging out in trading floors and actually watching what people do, as opposed to sitting in my ivory tower and hallucinating about trading or about economics. One of the things I've noticed is that
that's what I do. It's actually not an ivory tower, and I don't hallucinate.
So one of the things I've noticed is that, you know, there are a lot of people who call themselves economists, and in their models they tend to assume away transaction costs. So is it not true that in many economic and even many financial models, transaction costs are ignored?
Yes. So what? Have you read our paper, which I have right here? 70% of it is about transactions costs. I can't speak for the entire profession, sorry. I will speak for myself. We spent a long time trying to understand transactions costs, and here, you can have the paper.
Great copy.
And if I must toot our horn, a new survey paper of all the papers that have been written on this subject, there are a few others, but one just actually came to me via email last week by someone I don't know at all, named Neil McCulloch at the University of Sussex. I don't know if you've seen McCulloch's paper. McCulloch actually said that our paper takes most seriously the issue of transactions costs. So sorry if I can't speak for the whole profession, but I take transactions costs seriously and actually spend a lot of time looking at transactions costs in a range of markets, including, as you'll see in the paper, we looked at agricultural futures, you know, hog bellies, and on like that. By the way, I also was on the New York Stock Exchange trading floor about 2.5 weeks ago.
I'll just say a comment, second, the difficulty we had in finding out about transactions costs, because Jim, you're absolutely right. We are very interested. It's very important. One of the issues that you find, I'm just going to make this as sort of a general point about economic research, economic data. The reason Bob and I had such difficulty trying to find out about transactions costs is that much of this data is proprietary. So every day, the government this morning we put out the new data on employment. We could just go Bureau of Labor Statistics, download tons of data, zero cost. They make it user friendly. If you know how to play with data, you can do whatever you want with it. If you want to get data on transactions costs, it's really hard. We have to get a good guy like Jim who'll be good and discuss it with us and give us some information, maybe some he's not supposed to give us. It's extremely difficult. And it's not just the financial industry. Go and find out about drug costs. Very hard to find out. How much does it cost Pfizer to research and develop a new drug? Across the board, it's one of the problems, or I'll just say one of many problems that I think people trying to do good policy, do good research face, is that it's very expensive. And if you come from someone that's got very deep pockets, you work for the financial industry that has deep pockets, you can get this data. On the other hand, if you work for a small think tank like me or Bob at a university, it's very difficult to get the data. And again, it's not just the financial industry, it's across the board. It's just something to keep in mind. Bob, do you have a question?
Okay. I was very interested in your discussion on the carbon tax, which I support among many other initiatives to build a green economy. Ralph Nader was nice enough to mention some of my own research and consulting work for the Obama administration on this issue. So my question is, do you see any analogies between a carbon tax and a financial transaction tax if we accept, as you seem to affirm also, that the markets do not always operate efficiently, that they do not always operate with accurate information and act on inaccurate information, rumors, herds, stampedes, and that not that we would shut down the market, just like we're not going to stop people from buying fossil fuels, but we will discourage it. And we will have funds that can be used for beneficial purposes. Do you see any analogy?
Well, I see analogies with all taxes in that they need to be considered carefully in light of the broad tax system. And once again, I think you're missing the target. If you look at what the traders are actually doing, most of the trading is not done by speculators frothing at the mouth, going on rumors and gut hunches. Most of the trading is done by people with computer models who are basically doing that smoothing out that I said. Now, maybe you want prices to be more volatile, more jagged. I think that's your opinion, but you're missing the target. That's the big problem. And indeed, even if you look in markets which had higher transaction costs, people are still people. That the person who thinks that they're going to buy a social networking company at 80 and it's going to go to 500, you're not going to stop them with the transaction cost. That gambling instinct, people will apply in the financial markets. And putting a 50 basis point tax on is not going to stop that. What it will do is it will curb the beneficial activity. Now, there are better ways of achieving your goals.
Okay, I'll just quickly sum up a couple things, and then I'll let Gus come in with some questions from the audience. Just, again, I think one of the things to focus on is what this does to transactions costs. No dispute that it increases them. We're just talking about increasing them back to the levels of the 90s, early 90s, mid 80s, somewhere around there. The second point, again, I'm sure we differ, Bob and I would differ with Jim and presumably Gus on this, that what does it mean to have higher transactions costs? To my mind, there's no doubt that it means there'll be somewhat greater wedges, so that the gap between the buyer and the seller on a share of General Electric is going to be somewhat higher than it would be with lower transactions costs. That's by definition. But whether that leads to greater volatility, it might mean, we see the price of the share go from 60 to 60.5, then back to 60. We might see more movements like that. But I just point out, I think it's somewhat ambiguous whether it leads to greater volatility to the sort that I think most of us would care about. And my model here is the flash crash that we saw last year, where we saw prices fall, I believe it was around 15%, for no reason whatsoever. I mean, no one could identify any economic event in the world. What it was that you had program trading, all of which was taking advantage of the fact that you could do these trades at virtually no cost. So you could set up these programs, and they happened to be set up in a way that led to this spiral downward. I think you'd see less of that volatility. I think it's an open question whether or not that's the case, but it's at least my view, and I'll put words in Bob's mouth. He could disagree. I think you'd see less of that sort of volatility, which I think does pose a substantial economic cost. So I'll let Gus come in and ask questions.
Thank you, Gene. I have a whole slew of questions here. I don't think we're going to be able to get to all of them, but start off, actually, the first two are just a statement of fact, so I'll actually answer those myself. Didn't the bills introduced in Congress include exemptions from the tax for regular middle-class investors? There was a proposal to exempt up to a certain amount of trading, $100,000 worth, I believe. So yes, for a small amount of trading, you would be exempt. However, I would note that most investors actually do not invest directly, that they invest through other vehicles like mutual funds. 90 million investors in their 401k plans and other investments are investing in mutual funds, and there you really can't administer it. You can't figure out who has how much money and what part of the fund should not be subject to paying this tax. So that would be administratively impossible to figure out how to do. Here's a question for Jim Angel, Professor Angel. Even if you are convinced that the tax misses its target, would you agree that it would still provide a sufficient reserve to be able to tackle the next financial crisis instead of having to burden the regular taxpayer again? Or would you argue that trading would decrease so much that it would be unimportant in the future?
Well, I've actually taught a course on financial crises at Georgetown University, and at the heart of every financial crisis is debt, borrowing. People borrow too much to speculate. People, borrowed too much money to buy houses. People borrowed too much money to, buy bonds. Again, a financial transaction tax really wouldn't hit those people. Some of the worst of the players, would not be hit by that tax. So there's a lot we need to do to shore up our financial structure. We need to overhaul and have deep structural reform of our regulatory agencies. We need to have a much smarter regulatory system. We may differ on the details, but the revenue raised from such a tax, it would basically go into the general fund, and it certainly would not be used for, as a buffer for the financial system.
Bob, do you want to?
Well, there's no reason why it shouldn't be. In fact, if you read the IMF study, which proposes a variation, a financial activity tax, the proposition there is that first and foremost, the financial sector needs to be taxed in order that they themselves cover up and pay for their messes rather than the general taxpayer. So there's no reason why some of the revenue from a financial transaction tax could not be there to help finance whatever future bailouts might be necessary. And such bailouts would probably, the probability of them being smaller would be enhanced through having the financial transaction tax, because you'd have less speculative trading.
Another question here. This is regarding the traders who, quote unquote, stabilize the system, according to Jim. You describe them as trading the most. Are arbitrageurs who trade on tiny margins, aren't they the same people who created the flash crash?
Oh, I'm glad you asked that question, because I'm the guy who warned the SEC in writing 5 times in the year before the flash crash that our markets were vulnerable to exactly that kind of glitch. Now, what happened that day is that there was a very large trade that came in from a traditional mutual fund into the futures market. They sold a big basket of stocks in a sloppy way that pushed prices down. Now, then, you sell this basket of 500 stocks really quickly. Hey, we had flash crashes like that long before we had computerized trading, even when we had much higher transaction costs. You can go back to newspapers from the early 1900s and read stories that sound just like the flash crash. Markets break and then recover. Now, what happened was this caused such a flood of data that the information processing systems in the markets were overwhelmed, This led the arbitrageurs to step aside. So what happened was, the arbs said, the people who were looking at those very tiny differences said, wait a minute, I see a price of, in this market and that market that are normally the same, and they're dollars apart. My computer must be having a conniption. I don't believe the data I'm seeing. So the people, the hyper-rational traders, the ones who normally stabilize things, step to the sidelines, and that is when the market really fell apart, because the people who weren't doing the high-frequency trading kept on trading. And the stabilizers weren't there, and we saw Accenture go off at a penny, Sotheby's at $100,000 a share, mainly because the big glitch caused by a big order caused problems in the system. So, if you wipe out the arbitrageurs, we see bad things happen.
Bob, you want to address?
Well, I appreciate, and I know I've read some of your commentary on the flash crash, and I appreciate that you're calling it a glitch. And these things do happen. The only problem is they happen very frequently, and each time they happen, it's just some kind of glitch, some kind of, actually the crisis of 2008, 2009 was called a 100-year storm. That was the head of Goldman Sachs called it the 100-year storm. Of course, the odds of it ever happening are so low, but look what happened. It actually happened. 1997, 98, long-term capital management. The best arbitrage experts out there almost brought the entire global economy down because of their hubris as to their thinking that they could outguess the market better than everyone else is outguessing the market, and they're competing. And these people are not evil people. So stop saying that I ever said that, or that I'm suggesting that in any way. They are people operating within a framework set by public policy. And it is the obligation of public policy to establish a regulatory system that delivers financial stability. Now, if you study the history of capitalism, a classic book by Charles Kindleberger, the late Charles Kindleberger, called Manias, Panics, and Crashes. If you look at that book, we have had, throughout the history of capitalism, a chronic problem of excessive instability, speculation, crises, crashes with enormous social costs. We did have a period where those problems were largely cured. That was a period when we had a significant regulatory system in the United States and in the global system, the Bretton Woods system and the Glass-Steagall system in the United States. We need a regulatory system, and it includes control of low transactions costs, putting sand in the wheel, as Professor Tobin, the Nobel laureate, proposed with respect to transaction costs. We need those things. It doesn't mean we shut down the markets or that people are evil.
Okay, Bob, if you have your win back, I'll ask you another question. As trading has increased in recent years, what has happened to the savings rate? If people are getting such a great deal from all this trading, where is the evidence in median net worth?
Well, median net worth shot up as a result of the bubble, and then median net worth collapsed when the bubble collapsed. By the way, measuring net worth is not the same thing as savings rates, if we want to get a little bit technical here, what maybe you don't. Savings rates is supposed to be your total income minus your amount of consumption. That number is very, very low, historically low, and a big part of the reason is that people thought they didn't need to save out of income because they thought their net worth kept going up. Especially, with the real estate bubble. They saw their net worth go up because there was a bubble, so they saved less, and that created a distortion in the economy. So the savings rates have to be tied to what happens in the financial market, and so the interaction between changes in net worth due to bubbles creates another distortion in that regard as well.
And the savings rate has shot up to 6% in the last.
Well, the savings rate is up, and by the way, the level of reserves, the savings by commercial banks, is at an unprecedented level, $1.5 trillion. So, but that doesn't mean that that's money sitting there that also should be out there in the spending stream creating investment. So having a higher savings rate does not in itself benefit the economy. What benefits the economy is when people want to put money into productive activity that creates jobs.
Jim, do you have any comments on this?
No comment.
Okay. I'll go to the next question. I agree with the tax and urgent need to curb speculation. But if it is not agreed upon at the international level, the G20, the financial sector in the U.S. will warn of jobs lost or outsourced to other countries. Jim, you want to?
Yeah. We live in a global world. I can, on my smartphone, type into a brokerage account and trade almost anywhere in the world right now. So that's absolutely true. That if we try to squeeze the financial sector too much in the U.S., it won't be here in the U.S., and we're going to get rid of beneficial activity and push the other activity offshore. We'll divert people away from other productive activities into trying to figure out how to get loopholes into another complicated tax system to try to avoid paying the tax.
Well, first of all, we know, however big your stack is, the
320 pages.
The UK financial transaction tax is generating a lot of revenue, and we haven't seen the collapse of the UK financial markets. So there may be some movement out of the market, but obviously it has not been significant. Secondly, the seven most rapidly growing financial markets in the world, including China, South Korea, Hong Kong, Indonesia, all have a financial transaction tax. They all have a financial transaction tax. That's an interesting phenomenon if we think that having a financial transaction tax is going to lead people out of your financial markets. It isn't happening. Third, most important, there's a very simple solution, and it's in our paper. So I look forward to getting your comments on our paper. The solution is, with respect to the U.S., if you don't pay the tax, your transaction does not have legal title. Who's not going to pay the tax? Who's not going to pay the tax if they do not have legal title to the asset they wanted to buy? So that in itself will be able to control the outsourcing of trading out of the United States, because you can trade, but you don't own it until you pay the tax.
Thanks, Bob. I would like to make one clarifying comment. There actually has been an awful lot of activity trying to avoid the London or the UK 50 basis point stamp tax. Most of the ETFs created in Europe over the past couple of years have gone to a swap-based approach, a derivative-based approach, in order to avoid having to pay that 50 basis point
And
tax.
that's because it's only a tax on stock trading. So yes, you do need to have uniform taxation that applies to all types of trading. The problem, the Swedish case was brought up earlier. The Swedish case was an example of an absurdly designed tax. It only applied to domestic brokers in Sweden. So, okay, so you go to the foreign broker down the street. Why not? I mean, that's the equivalent of saying, okay, there's a sales tax in Washington on McDonald's, but not on Wendy's. So you go to Wendy's and you avoid the tax. That's what happened in Sweden.
Next question. If increased transaction costs for mutual funds are passed on as higher fees to investors, I would say that they're not passed on as higher fees. The transaction costs are not in the expense ratio that you pay, but they are in the performance that you receive. They're just not in the expense ratio. Wouldn't investors simply substitute to an unmanaged index fund, which have lower fees and historically comparable or better returns, while systemic risk is curbed? Of course, I love this question. But the index funds are still going to incur the transaction costs as well. In 2008, transaction costs would have been 0.40% for index funds if it had been levied. And that's just the direct fee. That does not include higher transaction costs. Here's one for both of you. Bob, you want to take this first? How many trades do speculators do in comparison to your good, this is to Jim's good bacteria in both size and frequency? So how much of the trading is actually speculators versus arbitrageurs?
Well, you know, the issue of good versus bad, I mean, the commodities futures market is an excellent example, as Jim brought out. I don't see any problem whatsoever in having a derivatives market, and, you know, less fancy term, an insurance market, right? You're a farmer, or let's say you're an airline. You're an airline, and you know you're going to be consuming a lot of petroleum over the next year, so you want to lock in a price so you can plan for your business. I don't have a problem with that at all, okay? And those, again, that market specifically as regards petroleum for airlines has been around since the beginning of airlines. Not a problem. They are shifting the risk. Essentially, the person who is selling that derivative to the airlines is selling an insurance policy. That's all it is. Now, the issue, though, is that the market has been overwhelmed. Over the last decade, it has grown by, I think, 400% relative to the level of the physical commodity, the oil, and has been dominated now by, we don't even have to call them speculators. We'll just call them people who are trading not because they have any interest in the physical commodity on either side of the insurance exchange, but they have an interest in moving the market and benefiting by having the capacity to move the market. That is excessive. Now, what the exact number is, we don't know, but that's why you have regulations, including increasing the transactions costs and earning revenue. But not only that, the Dodd-Frank law, I heard your negative comment about it, has problems, but it also has some good features if it were actually implemented, including, let me just say, including the phrase that the Commodities Futures Trading Commission, it has the authority to, quote, control excessive speculation in the futures markets, and they need to exercise that.
Thanks, Bob. Jim, do you have any comment on this?
Yeah. If we look in the equity market, it's generally considered that so-called high-frequency traders, you know, these are the stabilizers, the arbitrageur types, generally do probably about 50 to 70% of the trading. So these are the people who would be pushed to the sidelines if we put on a financial transactions tax. So it's hard to get a sense of who are the manipulators, which I think is what you're really getting at. I mean, we all believe that manipulation is wrong, and that's why we need good regulation. But a transaction tax will not really slow down the manipulators, because they're going in for the big kill. You know, they're not going in for the half a penny. You know, they're going in for the $10, $20, $30 hit. And to them, 50 basis points is nothing.
Okay, we're out of time for the Q&A session. We just need to wrap it up here. Jim, would you like to take 2 minutes to summarize your views?
Okay, so to summarize, that when we look at this through the lens of good tax policy, a financial transaction tax fails. It really won't generate the revenue that we think it will. It will have a lot of deleterious side effects, and there are better ways to generate the revenue. So this was a bad idea. Congress carefully thought about this, got rid of it, and for very good reason. Now, the financial sector of the economy has grown because we can do a lot more good things. Yes, we've always had commodity markets, but we've also developed ways, you know, in the last couple decades for companies to manage their interest rate risks through the swaps market, for banks to manage their credit risk, you know, with the ability to buy credit insurance in the market. So we've developed new products that allow people to do new and better things. So yes, we've had problems. Markets are not perfect. But throwing sand in the gears, well, if you've got a problem with your car, sticking sand in the engine is not really going to fix the car. And so putting sand in the gears of our financial system is not going to achieve the objectives that the proponents say it will.
Thanks, Jim. Bob?
What about our cars? If our cars are designed to go at 200 miles an hour and people are going at 200 miles an hour, we probably would want a law that says, let's reduce the speed of the cars, the capacity to, I don't know, 60 miles an hour. New York State had a transaction tax. I think Ralph might have mentioned that at the beginning. They actually still have the tax in place nominally, and then it's rebated. So we actually have data on the amount of revenue that is generated by the New York State tax, which only applies to the New York Stock Exchange. For the last year, the amount was $14 billion. If that tax had not been rebated, we would have, the state of New York would not be in a financial crisis right now at all. In fact, the level of the New York State's budget deficit is $10 billion. So we could fully pay off all the issues, and we would not be facing cuts in education, health care, public safety in the state of New York. Plus, we'd have $4 billion left over. Now, the idea that these taxes are so harmful to the operation of financial markets has obviously escaped the financial markets that are growing the fastest in the world right now. Each and every one of them has a financial transaction tax. China, for example, is using revenue from its financial transaction tax to help finance infrastructure in the green economy. I think that would be an excellent idea for this country. Now, markets are, yes, far from perfect. Markets do useful things. The financial market does useful things, but only when it's regulated. And when it is unregulated, I think far from perfect is an understatement. They are disastrous. We have experienced an economic disaster in this country that would be far worse if the financial markets were not bailed out by we, the taxpayer. So what we do need is controls on financial market activity. The financial transaction tax is not a panacea. It is one measure among many. Among the many, it is the one through which we can generate revenue and help cover the deficits that we face and not experience the kinds of things that are going on, for example, in Minnesota with the state shutting down.
Bob mentioned the New York transaction tax. Actually, I believe that if it were not rebated, the revenue raised would have been zero. The reason New York rebates that revenue is that all the jobs were leaving and going to New Jersey, and they had to stem the flow of Wall Street moving to New Jersey. Actually, much of Wall Street now is in Jersey City, New Jersey, so they were just trying to save the jobs in New York.
Since that was my final statement, and so maybe I get a little rebuttal here. The New York tax is based, as I said, just on the stock exchange. And so therefore, yes, it is not well designed because it should apply to NASDAQ, and for that matter, it should apply across the board. That's the way that you design taxes so that they are comparable, even across the board, fair to everybody. And we could do it in New York. We could do it throughout the United States.
With that, I'd like to turn it back over to Ralph Nader. Thank you all for coming today.
Thank you. I want to thank the participants first, Professor Robert Poland, Professor Jim Angel, Gus Sauter, and Dean Baker for reaching a lot of the dimensions of this subject, which I hope will be discussed in the coming future in the proper arenas with the mass media, the legislative arenas, and the political electoral arenas. I want to also thank the audience, very patient, very interested in the subject, and the audience around the country through C-SPAN when this event is relayed to millions of people. I want to ask anyone who is interested to stay in touch with us. There'll be future debates on taboo subjects. The website, as you can see here, is debatingtaboos.org. That's debatingtaboos.org. We'd like your reaction to the overall subject of opening up more and more taboo subjects, which once open, allow democracy to kick in and allow usually good things to happen, or at least allow our greater understanding of what's happening to us. There is a lunch and a chat lunch out there for those of you who are interested. This lunch has no transaction costs whatsoever, and today there is such a thing as a free lunch. Thank you all for coming.
Thank you.
Thank you.
That was really good. Thank you. Good job.
Good job.
Good job.
Neil Irwin, thanks very much for being with us here on C-SPAN.
Thank you.
First of all,